So you've probably applied for a loan at some point, right? A car, a house, maybe for a business. It's a huge part of how our economy works. But what is actually going through a bank's mind when they're deciding your fate? Well, today we're going to pull back the curtain on that whole process. It can feel like a total black box. You send in all your paperwork, cross your fingers, and just hope for the best. But believe me, behind the scenes, there is a super detailed, systematic process going on. It's like a high-stakes game of analysis and prediction. For a bank, lending isn't just one of the things they do. It's pretty much their main business. But it's a business that's completely built on taking a calculated risk. And if that calculation goes wrong, well, the consequences can be absolutely massive. Look, lending is literally the engine of economic growth. It funds everything from the corner coffee shop to huge infrastructure projects. But, and this is a big but, we all saw what happened back in 2008 with the financial crisis. When that credit risk isn't managed the right way, that same engine can bring the entire system crashing down. So yeah, getting this right doesn't just matter to the banks, it really truly matters to all of us. So where does the bank even start? It all kicks off with one surprisingly simple question. Why do you need the money? Yep, understanding your reasoning, the borrower's rationale, that's the very first piece of the puzzle. To make this all feel a bit more real, let's follow a little story. Let's meet Maria. She runs a fantastic bakery, it's doing really well, and now she wants to expand. She's thinking about buying a bigger, more efficient oven and maybe sprucing up the storefront. So she heads to the bank to ask for a loan. The very first thing the bank needs to figure out is the type of need we're talking about. Is this a long-term investment for strategic growth, like Maria's new oven? That's a loan that's going to pay for itself over years. Or is it a short-term need, something for operational cash, like just trying to cover payroll next month? That signals a more immediate cash crunch. You see the difference? It's huge, because a loan for growth is an investment in future profits. A loan just to cover costs, that could be a red flag for existing financial trust. Okay, so once the bank gets the why, it's time to put on the detective hat. The mission, should they choose to accept it, is to figure out exactly how much risk is involved in lending to someone like Maria. And the main thing they're looking for here is something called credit risk. It sounds complicated, but it's not. In the simplest terms, it's just the chance that the bank won't get its money back, like you promised they would. The bank's entire job is to put a number on that possibility, as accurately as they can. So how do they do it? Well, this whole investigation really breaks down into two main parts. First, they crunch the numbers. We're talking the hard financial data. But second, and this is just as important, they have to assess the bigger picture, all the stuff that doesn't neatly fit on a spreadsheet. Let's start with the numbers. When they're looking at the numbers, the bank is going to pore over Maria's financial statements. They're looking at her profitability, not just if she's making money, but how steady is it. They're checking her cash flow. Is more money coming in than going out every month? Super important. And they're analyzing her leverage, which is just a fancy way of asking how much debt she already has. A healthy business has a good balance across all three, and that's what builds a really strong case. But it's not all about the math. The bank also has to look at these, let's call them qualitative factors. How good is Maria as a manager? Does she have a solid, sustainable business model? Is the market for fancy bakeries even growing right now? This is where you really see that a bank isn't just lending to a balance sheet, they're betting on a person and their vision for the future. Okay, so the detective work is done. The bank feels like it has a pretty clear picture of the risk involved. What's the next step? Well, now they have to translate all that risk into a price, and that price is the interest rate on the loan. And this brings us to the absolute core principle of lending. Every single interest rate includes something called a risk premium. You can think of it as the bank's compensation for taking a chance on you. The more they think you might not pay them back, the higher that premium and your interest rate is going to be. Simple as that. So a low-risk borrower, like our friend Maria with her profitable, well-run bakery, she's going to get a much, much lower interest rate. But a high-risk borrower, maybe someone with messy cash flow or in a dying industry, they're going to pay a whole lot more for that money. A strong financial story literally translates into saving real cash. But hey, even after the loan is approved and the money is in Maria's account, the bank's job is not over. Not by a long shot. Now it's all about protecting their investment. They got to build a financial safety net. The bank is going to keep a close eye on Maria's business, always on the lookout for early warning signs of trouble. Are her sales suddenly taking a nosedive? Are her payments to suppliers getting later and later? Is she suddenly taking on a bunch of new debt from somewhere else? These are all red flags that could signal problems down the road with repaying that loan. So what happens if those red flags do start popping up? The bank always has a plan B. They manage their risk with a few key tools. One is collateral, getting Maria to pledge an asset, like her shiny new oven, which the bank can take if she defaults. They also use covenants, which are basically rules in the loan agreement Maria has to follow, like, say, always keeping a minimum amount of cash in her business account. It's all about building and safeguarding. So there you have it. From that very first question of why, all the way to the final safety net, lending is really just a story. The bank is reading the story that's being told by a borrower's numbers, their leadership, and their place in the market. And that brings us to the final question. And this one's for you. What kind of story are your finances telling?